Hello and welcome to today's episode. Today we are joined by Ian Matthew, partner at Moore Kingston Smith. Just to let our listeners know, Moore Kingston Smith is a full-service accountancy firm headquartered in London with presence in 113 countries. Also, I believe the firm is celebrating 100 years of its formation in 2023. Is that right, Ian?
It is, but I haven't been there for the whole full 100 years.
Well, congratulations. You will be witnessing the 100th year of the firm there, so it's going to be a proud moment for you. So let's start our today's podcast. Did you know, Ian, we did a short survey online asking people what were the top three concerns they would have when moving to the UK. Accounting and tax was at number 2 on the list, second only to accommodation. What are your thoughts on that, Ian? Is it right for business owners to be concerned about accounting and tax in the UK? How easy or difficult can it be?
I understand that there might be some concern about moving into a new market and the tax and accountancy needs, but the UK has been consistently proven to be one of the easiest places to do business. In fact, research on the World Index, actually, we're actually currently 8th for ease of doing business. The UK is open for business. Setting up a company is really simple. As with all countries, there's some slight nuances, but actually it's a relatively simple place to be. For example, in the UK, there's no state tax. There is just a federal tax. But it's always important to get a good advisor in to make sure you get through all that.
Thank you, and that's good to know. Can you share with our listeners on how Moore Kingston Smith supports businesses, particularly from India?
Yeah, of course. So we've been working with Indian businesses now for nearly 40 years, helping them set up in the UK. We hold their hand on all of those issues and concerns they might have up front, talking to them about their not just their business requirements, but their personal requirements as well. We like to think of ourselves as that their finance office in the UK. Of course, we don't do immigration; we leave that to the specialists. But driving that's the start of the conversation. From that, we can really help them and get them to structure their business in the right way in the UK.
Yeah, I think it's very important because 9 out of 10, whenever I start with, advising them on the immigration aspects as well, I think the concerns are more around tax, which is personal tax as well as company and how's it going to be. And there's a lot of an apprehension, a lot of myths, a lot of preconceived notions that they have. So I think it's important that they understand that it's not going to be very difficult. It's going to be relatively easy. What should businesses that are setting up subsidiaries in the UK need to plan for from a compliance perspective?
First thing, it's understanding what's going to happen and how long it's going to take up front. That's one thing. How much it's going to cost. But probably the most important thing is about their people. One of the biggest decisions any business trying to set up in the UK was being that will they be recruiting locally? Or will they be looking to actually put someone who understands the business themselves and the culture into the UK? It's that market versus product question, and then it's making sure that they think about that person's needs, where they're going to go, how they're going to be approach the market, what's their marketing strategy, and probably from a more practical point of view, it's how and when they're going to open a bank account in the UK. I say the UK isn't easy to do business, and it is. Probably the one niggle is it takes UK businesses, not even foreign owned, a little bit longer than we'd want to open a bank account. It's about 2 to 3 months.
Where do you think the challenge is? Is why does it take long? I mean, is there a lot of checks or more compliances, or is there anything in particularly that UK banks looking, or just the protocol?
The UK banks are looking at a bit more protocol for an anti-money laundering purposes. So the KYC steps are a little bit longer. So we do quite a bit of business with that. And actually do a lot of references and trying to identify. We ourselves have to do KYC as accountants. So it's looking beyond that structure of the Indian business, in my case, and looking at the shareholders and identifying and verifying their identity. And more often than not, the banks having to go through the same steps. We work very closely with our banks, with the likes of ICICI, HSBC, Barclays. Um, One of the things to mitigate against it is if actually one of the directors are coming over from India as well, one of the shareholders, that opens the pool of banks which might be um, happy to do that. There are alternative providers as well, so the challenger banks, but it's just that overseas element that sometimes the more risk adverse banks just want to maybe just avoid. But there's definitely bank accounts open and definitely available.
So coming back to what you just said, Ian, is when the company is looking to enter the UK, and you're saying that it's also important as one of the pointers that you said is they need to be aware of whether they would want somebody within the UK to work with them, or would they be bringing in their associates. How does that impact the taxation? Do you think it's easier to have somebody locally to work with them, and rather than bringing people from out, or what do you think from taxation point of view is more kind of effective way to do this?
From a tax perspective, it doesn't impact it too much. The biggest concern is if so one of the main questions I always get asked for having a UK company is, does it matter that the directors are based in India, and how many
Mm-hmm.
directors they have to have? They only need one, and it doesn't matter if they are based in India. It does raise the question of place of effective management. The Indian tax authorities may want to then tax the UK entity, but double taxation treaties are there where actually will mitigate most of that. So the biggest tax thing to consider is from the individual, if they're being seconded from India to the UK, is the level of income tax that they will be charged. Um, it's the same rates that would be charged of the UK employees. So it's more about the team that you're sending out there and how you can mitigate the costs for them and the business.
I think another one popular question that we come across in business and would want to check whether they should be setting up subsidiaries or branches, do either offer an obvious benefit?
Of course, yes. So actually, some of the biggest Indian businesses in the UK are actually branches. So TCS, Infosys, they all have branches in the UK. It's very appealing. The main reason the larger entities do it is because if you have got a branch in the UK, you have to publish your Indian company accounts. And the bigger entities don't really mind about that. But if you're a smaller entity, you don't really want to share your accounts from India with your competitors,
That's right.
because it is freely available in the UK. Um, the biggest deciding factor on the two is generally about limited liability. So that UK entity, if it's a subsidiary, it's ring fenced, it's got limited liability. If anything might go wrong with a sales contract, for example, that's it. It's within that company. It never impacts on the actual existing business. While a branch it's an extension, it's a division of that business. If the same sales contract does go wrong, that becomes an issue for the actual existing business. Coming into a new market, it's just cleaner. And actually, also having a subsidiary, its own entity, has a stronger presence for that market you're trying to sell to in the UK. Probably shouldn't do, but seeing it's there, it's a limited company, it gives reassurances.
Brilliant. That helps. Thank you, Ian, for clarifying this, which brings us to another question that mostly would be around taxation. And we understand that tax rates are recently been revised in the UK. Can you tell us more about the tax rates and the current revision that's happened in the UK?
The 1st of April this month, the corporate tax rates increased from 19% to 25%. The 19% is still there if you have profits up to £50,000 within the UK. So initially, when companies do start up, they will be in that bracket, I'd imagine, before they scale up to the higher level of 25%. 25% comparing to other global rates is not actually that high. And also the UK, as I said earlier, doesn't have any state tax. The 25%, that is it. That is the only tax you'll have on your profits in the UK, compared to, say, It's still not as low as, say, Ireland, which is at 12%. But given that internationally there's trying to be a minimum rate of 15%, the 25% is probably going to be here for the medium term. Though there's lots of conversation over here that actually that's a short term rate to help fund some of the COVID support there was in the previous years.
Oh, that's good to know. And I think it also puts rest to a lot of, interpretation about these changes that happened, and the guesswork that's happening with the prospective business owners to say on how it's going to be. So I think it really clarifies in terms of how do you look into this particular revision here. And also for companies setting up in the UK, can they get any kind of an employment tax relief?
That depends very much on the setup. So, for example, if you are, depends on the visa, which is definitely your speciality. So, if they're being seconded, so if it's a temporary workplace, then there are lots of reliefs available. So, you can look at social security arrangements. Employers' social security, there is an exemption for Indian businesses seconding their staff into their UK operations for up to 52 weeks. So for 52 weeks, there wouldn't be any employer social security. If the team won't be purely based in the UK and they're all over the continent, and so if they're only going to be based in the UK 60% of the time, they'd actually only be taxed on 60% of their income. If, for example, they are going to be over here on a temporary workplace, then the living costs, the actual accommodation for a reasonable rate, could be an allowable deduction against their income. Again, all of which depends very much on the circumstances of the individual and the visa, and it's something certainly to talk about before they come to the UK. You could be paying very little tax on income tax on the individuals if you came over here on a temporary basis.
When they're trying to enter the UK market, they really need to strategize this, isn't it? To understand on, how are they going to place the different associates? What would be the number of associates on a long-term basis? How many are okay on a short-term basis and things like those? And then they should plan this properly before they kind of even enter the market. Is that what you advise them?
Very much. So it's moving into any market. You need to know how you're going to attack it. So who are you targeting, how are you going to target them, with who, for how long, at what resource. And tax is a cost, and it's about managing those costs and maximizing the returns on that market. So yes, if you can do as much planning up front, then there's clarity to your mission and a higher chance of success.
And staying with the theme of taxation, one of the main areas of interest is for companies, individuals to send money to their subsidiary in the UK. How are these remittance treated in the UK? Are they taxable or are they exempted? Can you share your thoughts on this one?
The UK looks at this as funding and will treat it as such. It's either share capital that you're investing, and therefore that's it. That's it. It's money coming in, or it's a loan. Again, not income. It's a loan, potentially repaid, not taxable. The thing which actually drives this conversation a bit more with my Indian clients is what declaration are they going to have to make to the RBI? So, and how often? That's the main point. So more often than not, my recommendation is to put some seed funding in, capitalize it, because ODI is a one simple declaration to be made to the RBI. And if you can do that every 6 months, year, 18 months, perfect. They can then just draw down on those funds as is appropriate. But in the UK, not taxable.
I understand one of your specialty area is also real estate. Is that so? Do you also advise in the UK real estate market, or on how do they buy properties, etc.?
Yeah, very much. I'm one of the lead partners on our real estate group. It's for looking at people who are looking to invest, to do property development, and construction. So, in fact, I've just advised an Indian business on an acquisition of a hotel in central London, which is we've seen a number of over the year. It's a very popular market for Indian investors. One of the things to consider is what structure you put that investment, because it could be personal as well. So that's another feature of working in the Indian market, is that actually a lot of people want to buy residential property to live in. If they want to do that for a company, there are implications from a tax perspective if they then live in them. Though it might be easier to move the funds from India. But actually, moving money to buy real estate in the UK is fairly simple as well. And as with opening a bank account, there's a little bit of KYC to be considered. That people want to understand where the money's coming from. The biggest tax implication to consider from getting the money across is whoever's going to spend that money and bring it into their own account is what their tax residency is. So if it's into the company, it's a bit simpler, depending if it's just from an investment point of view. But if actually it's going to be in their personal name, sometimes you just need to consider the tax residency of the individual. So if that and how that money's moved in, because what you want to avoid is that income being brought into the UK and being taxed in the UK, which there are plenty of ways to mitigate that, but it will depend very much on the individual circumstances. But if it is going to be personal, you just need to consider it. But it's property market's good. The prices are a bit softer at the moment, but just means there's huge opportunities in the UK to get a bargain.
It's a right time for the investors to enter, isn't it, in this market? Is that what you're saying?
It's long-term investments. The market's softening at the moment, and so there is some good bargains out there.
So, is there anything in particular that you would want the Indian residents who are trying to remit monies to the UK to invest in the UK real estate? Is there anything in particularly that you want them to be mindful of that is some key suggestion from you on what they should be very careful when they're doing this?
Two biggest things about any real estate deal is one, how are you going to bring the money in? How are you financing it? Making sure that's done in a transparent and clear way, but also what is your exit strategy as well. So if it's a long-term investment, that's not a problem. Is it a commercial development? Are you looking at student housing, that sort of thing, which is very popular and is very good for the rental yields. So they're the two key aspects they need to have clarity on, is how they're financing and how they're going to get out again. It could be that they want to develop the portfolio to hand over to the next generation. It's having that clarity.
What do you think about the exit? Do you think it's very easy for the investors to exit if they have entered the UK market?
So from a tax point of view, the gains will be taxed in the UK. So residential property is taxed at 28% in the UK. If it's for a company, that'll be taxed at its corporation tax rates, and then there's a pot of cash left in the company. But getting the money out isn't difficult from the UK from that aspect. It's selling it. It's then looking at the double taxation implications of when the money is taken into India.
Another question that I usually get from the client, and I think we did have a recent conversation as well with you with regards to high net worth clients who already have a lot of assets outside UK, and before they enter these questions in their mind is, would they be taxed for the incomes that they have or they get outside the UK for the assets that they have? Do you think that is something that they have to look into? Will there be a taxation for the incomes that they are earning outside the UK as well in the UK?
That's something to certainly consider before they come in. So if people are asset rich with passive investments and are having income being generated, it's where does that income sit, and does that income ever need to come into the UK? So it's the tax residency and the tax domicile rules. So tax residency is where you live, tax domicile is where you're from. If you're a tax resident in the UK, the tax authorities will look at you and try and tax on your worldwide income and gains. So if they have got assets outside the UK and it generates income, they will look to tax it. Now that is the default position, unless you're tax domiciled outside the UK. And then there will be other options available to you. So in the right circumstances, there's something called the remittance basis. So under the remittance basis, you're only taxed on any income you generate outside of the UK if you then bring it into the UK. Where there is sometimes a complication is where you've generated income since becoming a tax resident in the UK, you then put it into the pool of cash that capital you've generated before becoming a tax residency, and the waters get muddied. And so you need to really have a clear trail of where the money's come in from. And if you can prove that, fine. But actually, from a simplicity point of view, it's sometimes worthwhile just opening a separate bank account, a new bank account, and all income that you generate from all your passive investments since becoming a UK resident, just go into this new bank account and don't touch the capital or the cash that you've generated before becoming a UK resident.
It would be very helpful to the listeners because that's it only comes with somebody who's got a lot of practice experience to give you this kind of an information to say on how do you deal with this one, this particular situation here, and I'm sure that's going to help. So I think when it comes to taxation, there is investors, there's business, and most of the time the questions are by the business owners and individuals who are going to invest. But there's also one category of people who are entering the UK as an employee for the organization, and then whilst they're working, they may be for a short term, but then there's still taxations that they have to pay. How does it work when they're going to come back, assuming they're not going to take any rights in the UK? Is there any benefit? Are they treated differently than the one who eventually settle down in the UK?
So if they're looking just to move to the UK to do their job, that falls more under that temporary working place that I mentioned earlier. So they are taxed on their salary in the UK. They do have to have a UK employment contract. They do need to look into, and actually they need to be very wary about how much they earn and how they earn it to make sure they're compliant with their visa. It's the temporary working place rules would apply, so those exemptions for certain amounts might apply as well. They'll have to file a tax return in the UK. They'll be taxed on their income in the UK, but then they also need to be wary of that tax residency versus tax domicile rules, and just as they would for if they were an investor.
So I remember sometimes back they had this opportunity that, when you come back to your home country, you can actually claim your taxes that you've paid in the UK because you didn't actually take any rights there. Is that still in existence, or?
There is that double taxation element on there. So if you are being taxed in both countries, yes, there is definitely that amount. So you should only ever pay the top rate. So for example, if you were being taxed 10% in one country and 20% in the other, you'd pay your 10% in the other country, but you'd only pay the top up in the second country. So that's generally how those would work on that. And but again, that depends on the individual circumstances of the individual. But yes, you should never be double taxed.
And how about the students? Students nowadays have 2 years of additional rights to work, and if they work, do they still have to pay taxes, or can they claim that back? Yes.
Students tax as individuals, employees, individuals. So there'll be the tax thresholds that apply to those. So more often than not, they'll have certain exemptions because of they're in full-time education.
I thank you so very much. You kind of helped to understand the different immigrants who are trying to enter under the different routes. And thank you so very much, Ian, for taking this time out from your schedule and sharing such valuable insights with our listeners. We're delighted to have you on this edition here.
Thank you so much for having me.
Thank you.